Good afternoon, ladies and gentlemen, and welcome to the DILLISTONE Group results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, you will see we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in, via dillistone@walbrookpr.com. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive Jason Starr and Finance Director Ian Mackin.
Tom, thank you. Hi, everybody. Welcome. My name is Jason Starr. I'm the CEO, and I'm joined today by Ian, our Finance Director. Thank you for joining us. We appreciate we've lots and lots of things to do at 3 o'clock on a Tuesday afternoon or whatever it is. So we appreciate you giving up your time to talk to us and hearing from us in terms of our feedback on last year and our expectations for the year to come. In terms of last year, we think it was a year of progress. We've delivered our first recurring revenue growth for a long time. We have delivered results that on a like-by-like basis are substantially better, significantly better than previous years. Ian is going to talk to you about the makeup of those numbers and what we mean by adjusted. He'll take you through all of that momentarily. But we feel it's been a year of progress as we build towards a return to profitable growth, which market expectations suggest will arrive this year. I would imagine that the vast majority of people on the call today already know us, but for those that don't, thank you for participating. We appreciate your interest. I'll very briefly explain what we do. So we are not a recruitment company. We are a technology company that provides solutions into the recruitment industry. So our typical client will be a recruitment agency or an executive search firm. We also have a small number of in-house recruiting teams at major organizations. All of our products are delivered through a single operating business, that's Ikaru People, and we have various products underneath that. Talentus and FileFinder plus Gated Talent, they're all focused on what we call the executive search side of the business. Voyager Infinity, Mid-Office and ISV are all focused on the contingency side of the business. And as you'll hear during our time together, we have some positive things to say across both sides of the business. So what I'll do, if I may, is click on that and I'll ask Ian to talk you through last year's numbers in a bit more detail. Ian.
Thank you, Jason. This slide gives you an overview of the journey DILLISTONE Group has been on during its time on AIM. To start with, DILLISTONE grew organically and followed it up with a period of acquisitive growth. During this time, we were one of the highest yielding tech stocks on AIM. By our own admission, we had a couple of tough years with the loss of a large client and a product not performing as originally expected. We did recognise this and made structural changes to the business, which were starting to bear fruit in the second half of 2019, and then COVID hit. Like many businesses, we've taken advantage of support schemes in various territories to help us through the pandemic, but we also took the opportunity to further streamline the business. This means looking to the future, we're now a very lean business with the recovery underway, and we're primed to turn that future revenue growth into bottom line gains.
If I could just add a bit of colour to that, I think when people look at our history, they see several years of poor performance, and we've had several years of poor performance. But I think the point that I think Ian is making with this slide is that we actually had a substantial problem, which, we made some bad decisions internally. We fixed those issues, we turned things around, and then COVID hit us again, and that hit us for 6 again. So with our view now is that we've dealt with 2 sets of crises, and we're now coming out the other side. You'll see a bit more of that momentarily.
So this slide contains the headline figures published in the preliminary announcement. It does contain some positive movements in revenue and operating cash both being up. However, we do believe that to get a true comparison, you've got to adjust for the furlough and government support received in 2021, which wasn't present in 2022. When you do adjust, a much more positive picture emerges of the underlying business performance. Total revenue is up 2%, which is the first revenue growth since 2016. Recurring revenue also showed growth for the first time since 2016. The turnaround is starting. Adjusted operating cash increased by 45% or 370,000. The order book was up 3% and TACV, which stands for the total annualized contract value, was up 4%. TACV is a forward-looking metric used in the software provider space to estimate what the next 12 months recurring revenue will look like. It's based on what the company currently knows, so it adjusts for known decreases but does not capture the anticipated future growth we expect in the next 12 months. Adjusted EBITDA is up 27% at 949,000, and adjusted loss before tax reduced by a third to 453,000. All this gives us confidence we are on track with our recovery. The underlying operation is undoubtedly improving. Running through the P&L, as previously mentioned, revenue is up 2%, which is the first increase since back in 2016. Although gross profit is slightly down, once we adjust for the impact of furlough and government support, the adjusted EBITDA is up 27%, and the adjusted EBITDA margin has improved to 16.6% from 13.3%. The depreciation and amortization has stayed broadly level, and the interest paid edged up as we benefited from an interest holiday on our Sybil loan in the first half of 2021. We can see the effect of the furlough and government support items that we received the benefit of in 2021 at 389,000, meaning the reported loss did increase to 453,000. The underlying cash position is also improving. Once furlough and government support are stripped out, the adjusted net cash from operating activities increased by 45% to 1.189 million. The investing activities, which is mostly our spend on software development, is broadly similar at 1.022 million. All this leads to an adjusted net change in cash being 58% better, or almost $500,000 better than 2021, and trending towards neutrality. Cash finished the period at 433,000, and we don't have any belief that we will need any extra cash going forward from now. On this chart, which explains away the cash movements, the green bars indicate all the exceptional inflows received through loans or government support in the periods, and the red bars are all the cash outflows associated with acquisitions, dividends, and the financing and repayments of those loans taken out. This leaves the blue line indicating the underlying cash movement in the half years due to the actual underlying operation of the business. As we can see, at the start of 2017, the operation generated a healthy surplus, but then things started to decline. As a business, we recognised the decline and reacted by reorganising during 2019. We were just beginning to see the turnaround with the underlying operation cash positive in H2 2019 when COVID hit. Like most businesses, we were hit hard initially, but we regrouped, and we can see steady progress from H1 2020, and this past year, the underlying cash, operational cash for the financial year has turned positive for the first time since 2017, with both half years recording positive balances. Let me hand you back to Jason to take you through the rest of the presentation.
Cheers, Ian. So yeah, just to reiterate the point here, I think this shows clearly the shape of the business over recent years. We had a tough time, we fixed it once, COVID, you can imagine we sell into the recruitment sector. No one was recruiting when COVID hit. We struggled. We brought in cash, but you can see we've been improving consistently since then. As Ian alludes to, last year, from an operational perspective, cash was positive in the business, and we expect that to be the case going forward, which is why we're comfortable with the to say we don't expect any additional funds to be required in the business. So in terms of the future, we go into 2023 with the strongest position we've been in for a very long time. As you saw from Ian's presentation, TACV, which is our forward look, is growing. We come into the year with recurring revenue on the up. In the first half, the expectation is, and we've said this, that for the first time for many, many years, we will deliver recurring revenue growth on both the contingency, i.e. the high street agency side, and the executive search side. So for the last few years, it's been a case of contingency has been doing sort of okay, whereas executive search has been poor. For the last couple of years, we've seen contingency start to accelerate, and now we're seeing executive search having bottomed out, returning to growth in this period we're in right now. What really is true about business, though, is that it's now highly geared. So as revenue grows, we expect to see performance improve rapidly. As we've touched on, for the year we're in, we have good recurring revenue. We also have a large contract that we announced about a month ago. That is likely to show value in the second half of this year. The value of that is dependent on a whole host of criteria, but it is likely to be one of the largest, if not the largest, contracts we've had since we restructured a few years ago. What that actually means is that we've been able to make a statement like that 3 times in the last 18 months, all of these relating to contingency clients that have signed up with us, all of them with significant contracts of a type that maybe not huge in the grand scheme of things, but by our standards are bigger than normal. So lots to be positive about on the contingent side. On the executive search side, as I say, our recurring revenue on search is likely to improve in H1 of this year for the first time for many years. That's driven by 2 things. Firstly, our file finder product is performing much better now. We did some work over the last couple of years to re-architect that, to take cost out of hosting, so we can now host it much more cost effectively. But we've also, in doing that, made the product much faster. That's made the client base happier. We've then given them free access to Talentis as well. And as a result of that, we've been able to increase the price. So now the file finder product is it's doing a much better job in terms of retention, and it's providing us with a higher margin than it would have done previously. But the real growth opportunity for executive search is the Talentis product, which is a product we launched 2 years ago. The executive search market is struggling at the moment for obvious reasons. If you look at the most recent data from the government, I think we said that the last 9 months in the UK, we've seen a reduction in published vacancies. Those vacancies are the vacancies that exec search firms would typically be trying to fill. So our clients are struggling. They're downsizing. They are reducing staff. They're not spending money. But Talentis is now our fastest growing product. In Q1 of this year, we sold more Talentis systems than any other product, despite that market. In Q1 of this year, we saw TACV growth on Talentis better than any other product, despite that market. And our confidence is high that as the economy starts to recover for exec search firms, we will start to see much more revenue coming in through the Talentis product. And the Talentis product is very high margin. I wanted to share with you an understanding of who our typical clients are on Talentis at the moment. There's some slides on the screen here. And just to give you a flavour of how international our clients are, we have users, just looking at this slide, Accord are in Belgium, Alto Partners are in Germany, Arthur Hunter in Romania, Henley Partners are in the UK, Johnson is in Australia, that's the second time I've said that today, Kestria is in Austria, MRI are in the United States, Mercury Ervel are in the Netherlands, Odgers are in Switzerland, the Garner Group are in the US, Signium are in Singapore, and Intersearch are in Germany. So just that handful of customers there gives you a flavour of how global the take-up of this product has been. Most of these firms have a relatively small number of users on the product, and most of these firms have a lot more people than not currently using the product. So we believe that, again, as the economy improves, we'll have the ability to extend our footprint with these firms, but also sell into an awful lot more firms. So we remain very excited about Talentis. We think that the revenue figure that we're looking at internally would be considerably higher if the economy hadn't tanked on us. But as I say, it's a product that is growing despite the wider context, and we believe it's taking market share, and we're very excited about the future of that particular product. So that essentially brings me to the end of my prepared notes. I will be happy to take any questions. Tom, do we have any questions that you want to bring up?
We do indeed. Yes. Thank you, Jason. Thank you, Ian. We have a number of questions. However, please do continue to submit your questions using the Q&A tab on the top right-hand corner of your screen. I'd like to remind you that a recording of this presentation can be accessed via your Investor Meet Company dashboard, and that your feedback is important to the company. So immediately after the presentation has ended, we will be redirecting you for the opportunity to provide that feedback. We have a couple of questions, and in fact, you've touched on them a little bit within the presentation itself, but I just wonder if you can add a bit more colour, quite possibly. We've got two questions from Glenn. Glenn, the first of your questions will be best served actually by the report and accounts, which will be published before too long. But Glenn also asked about the recent large contract that you announced, and whether you can just add more detail, a little bit more colour in terms of exactly what that is and what impact that might have.
Thanks for your question, Glenn. So in terms of a new contract win, it's on the contingency side of our business. It's a UK-based recruiter. They are a business that has several business units, and one of those business units was using one of our products. The other parts were using other suppliers' products. They went into the market. They wanted to have a single product that met the requirements across the entire group. They looked at various firms, including our direct competitors, and they chose to implement us, which obviously we're delighted by. In terms of the value of the business, the nature of the contract is such that there's a certain amount that will happen, but there are some development projects being built in, which we're being paid for. There are some of those are known to happen, some of those may happen or may not happen. There's no reason to think at the moment they won't all happen, but that's the nature of the contract. So that's why we've been a bit unclear about the full size of the system, but the likelihood is that it will be certainly very likely to be the biggest contract win we've had since the restructuring. As I say, there are a few question marks around the actual size of it, but I think even with the worst reasonable case scenario, it will be, by our standards, a notable contract win. And as I say, that's the third large, in quotes, contract that we've announced on the contingency side in the last couple of months. Hopefully that answers your question. In the last 18 months. Sorry, yes, thank you, Ian. That's why we need a beat counter on hand to make sure I don't get my nuts in the next day.
Good, excellent. So a bit more colour there. Chris has asked, are you looking to expand the product offering to customers, and what does this look like, and what investment is required?
Yeah, thank you, Chris. It's a good question. So to answer it in reverse order, we are basically maintaining the current level of investment in product development, but we are focusing the investment much more on the products that we believe are likely to generate value for the business in the medium and longer term. To give you an example of that, last year we took off the market a legacy product called VDQ. That was a product that was essentially an older version of Infinity. We gave our clients 12 months to switch to Infinity or leave us. And as a result of that, the revenue from that group of customers, they're now paying us 95% more than they were previously, and we have less customers to focus on. So with our development, we're doing much a similar process. We're looking at products that we think have a future. We're focusing our investment on those, and that remains the same. We are clearly improving our products, but we don't expect to increase our product development beyond the level it's currently at significantly. But yes, we will be delivering enhancements and improvements for both our contingency and executive search clients over the course of the coming months. Excuse me.
Great. Okay, super. Two questions that are very similar. Richard and James have both asked about new clients. James's question is, the business looks highly operationally geared and would generate very attractive cash returns as revenue increases from here. What's the strategy on sales?
Thank you, James. I would entirely agree with you. So again, we've got a number of products, and obviously they all have different strategies. We've seen, and we've touched on this, the contingency products are already growing comfortably, and the new contract win will certainly support that. On the exec search side, the opportunity for Talentis is very significant. I mean, literally, to give you an understanding of how the Talentis sales process works, in most countries, I don't want to say all, but certainly most countries that we care about, if you go to Google and you type in executive search software, Talentis comes top. The user can go to our website, they can, if they wish, watch a webinar, have a demo, they can take a trial without speaking to any human being. They can use the product for a week free of charge to test it, and if they like it, they can put their credit card in at the end. So there's virtually no human involvement in that process. Yes, they have demos. I do demos. I go to conferences. I talk to people. But the actual process of a sale, it's basically hands-free. So it's very high margin, and we can literally sell it worldwide. As I touched on in my slide earlier, where I shared the clients with you, or some clients, obviously a subset, we have clients using that product now worldwide on every continent apart from Antarctica. So, and that's basically done with one salesperson, essentially. So Talentis is a product that, as the market improves, as the economy improves, and the companies that it sells to start to get back on their feet again, we feel there's a really significant opportunity for it. And to emphasize your point, Talentis is our highest margin product. It's been designed as such. It's a true SaaS product.
Okay, great. Well, I think you've actually covered another question that we've had in, which was from Mark, which was, how can you leverage the offering in global markets? So I think you've answered that one as well. So
yeah, so just to add another point. Sorry, Tom, apologies. Just to add another point about, thanks for your question, Mark. So as I say, Talentis, or your question, comma Mark, as opposed to your question mark, Mark. But Talentis, as I say, our exec search products we've always sold globally. The contingency markets are much more UK focused, because one of the strengths of our position in that market is temping laws are different in every country, and therefore, for us to sell a temping product in the UK, our product is relatively protected from some of our international competitors, because a US product would have been designed around different laws. So, but Talentis and our executive search products are truly global. Thanks, Mark. Sorry for interrupting you, Tom.
Yeah, that's all right. And then Richard just followed up with another question, which follows on from how you get new business, which is, how do they become aware of you? And I guess maybe you can add some colour to that.
Yeah, I mean, it varies in different ways. So again, with most, we have a number of products. Every product is different, etc., etc. The exec search firms have a couple of ways of finding us. If they go to Google, as I say, generally speaking, we will be top, or in the top couple of rankings, pretty much any country in the world. So if you're Googling to find a product, you'll find a product. We also use what's called SDRs, sales development representatives, who contact people on LinkedIn and book in demos. We do webinars, and we also get a lot of referrals. We've started doing conferences and exhibitions as well, but that's not a major part of what we do, because it's, we generally don't need to. So the majority of our people come to us.
Okay. A quick question for Ian here, looking at the balance sheet. Could you give us your latest position on interest payments and outstanding loans? And then the second part of the question you've already touched on, but maybe you can just give more comfort. Are you confident that you won't need to raise additional cash?
Yeah, we are confident that we're not going to raise any additional cash. We obviously took out the Sybil loan during the pandemic. That at year end was just over £1 million. We're paying that down out operational cash flow. We don't think that situation's going to change. We're very comfortable with our cash position at the moment going forward.
Great. Okay. And one more for Jason. You've touched on the economy and the impact on recruitment. Is it not reasonable to assume that you'll struggle to deliver growth if your clients are downsizing?
It's certainly a reasonable assumption, but as I say, we're already doing it. The recruitment market has been in contraction probably for the last 9 months, according to the government state data, but we're growing. So we accept to accelerate when the economy improves. But certainly it is true. But our current customers, some of them are smaller than they were 12 months ago, and as a result, they will have less licenses with us. But we are. We're looking to grow revenue. We expect to grow revenue, recurring revenue in H1 of this year despite that, and our expectation is certainly that will accelerate as our clients start adding rather than removing licenses. And obviously, when a customer adds a license, it's so easy. It's just straight to the bottom line almost.
Yeah, great. Okay, super. All right. Well, I appreciate your time. Thank you both. Just for the diary for everybody, DILLISTONE.
Sorry to interrupt you. So just for anyone who isn't aware of this, we have Tom is sat in a different location to us. Tom's our PR guru and investor relations guru. I'm sat in the meeting room with Ian, and we can actually see the questions as they come in. Tom very kindly is protecting us from a question, but I'm going to respond to it. So I appreciate the question. Glenn has asked about executive compensation. What I would say is that will all be in the annual report when it's published. What I would suggest is that if you look at the annual report and feel that it's not appropriate, either our remuneration committee or I personally will be very comfortable to talk to you. But if you look at the cost of our board and look at it over recent years, I think that you'll find it's not I don't think we have questions to answer. But if you check the annual report when it comes out, if you have follow-up questions, do contact me or do contact the remuneration committee. It will all be there. And as I say, we've not seen, well, see for yourself. But yeah, I'm not too concerned about answering that question, but I appreciate your asking. Sorry for interrupting you, Tom. Over to you.
Not at all. No problem at all. So for the diary, DILLISTONE expects to be presenting at the Mellow Investors Show in Chiswick on Tuesday 23rd and Wednesday 24th of May. Interested investors should visit mellowevents.com, and I'm sure many of you are familiar with that event, but it's a good chance to hear DILLISTONE amongst others and get face-to-face with the directors. So could I ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide feedback. But Jason, maybe ahead of that, you could just give us the 20-second summary of where you see the group right at this point in time.
Oh, thanks, Tom. Yeah, so I think we are on a turnaround, and we've completed the turnaround, and we're going to hit market expectations this year, which will show revenue growth and return to profitability. So, you know, we think that we're in a good place, and we've had some difficult years, but as revenue grows, as one of the questioners asked or pointed out earlier, we're very highly geared, and we expect a substantial part of that to flow through, and we're optimistic about the future. But thank you for joining us.
Super. Great. Okay, lovely. If anyone has any further questions or would like additional information on DILLISTONE, please do get in contact via dillistone@walbrookpr.com. If you have additional questions, as Jason has referred, please do give us a line, drop us a line. And for the moment, many thanks for attending.
Thank you. Appreciate your time. Thank you. Bye-bye.